If you want to invest in commercial real estate, this is hands down the strategy that you should start with if you don't know where to start. You've seen the big deals, the high-rise office buildings, the massive apartment complexes, and multi-million-dollar shopping centers. They're all massive, and I know what you're thinking. I don't have that kind of money or experience, and you don't need it to get started. So what if I told you there's a strategy that is ideal for investors just like you? A way to get started without millions of dollars in the bank, without years of experience, and without taking on massive risk. It's called value-add commercial real estate, and it's one of the most approachable ways to break into the market, build wealth, and scale up over time. So let's dive in. Commercial real estate can feel intimidating at first. I get it. But that's exactly why value add is the best entry point strategy for new investors. It's designed for those who want to start small, improve a property's value, and scale up. So here's how it works. Instead of paying top dollar for a fully stabilized asset that's already cash flowing at its absolute peak, you look for properties that are underperforming. These are buildings with issues like below market rents, meaning tenants are paying way less than they probably should, or high vacancy rates. The property just isn't being leased to its full capacity, or maybe there's deferred maintenance, things like outdated interiors or exteriors. There could be bad lighting or maybe even a neglected parking lot. There could also be poor management, which we see all the time, and the current owner maybe just isn't optimizing operations, which could lead to unnecessary expenses. And that's where the opportunity is. Because when a property isn't fully running at its full potential, you can step in, make smart improvements, and force the appreciation, meaning you increase its value just by making it more desirable and signing better leases, not just by waiting for the market to tell it to go up. One of my CRE Accelerator Mastermind members, Chris Thorndike, used this exact strategy on his first commercial real estate investment. He bought a rundown 2-building property for $400,000, fixed it up, leased it out to a handful of tenants, and is now cash flowing over $30,000 a year. That is the power of value-add investing. And the best part is that this strategy allows you to start at any level. Whether it's a small office building, a retail strip center, or a multifamily apartment complex, you can apply these same principles to build wealth in any type of commercial real estate. So now that you know why value-add commercial real estate is the perfect starting point, let's break down exactly how to do it step by step. Step 1 is to find a value-add opportunity, a property that has untapped potential. Due to all of the reasons that we just covered, maybe it's below market rents, high vacancy, poor management, doesn't matter. You got to find something where you know that could be improved and we could do something better. Step 2 is to make the strategic improvements. Now that you've found that property with all of that potential, you've got to improve it in ways that increase the income and lower the expenses. That doesn't mean a full-scale renovation. It means targeted upgrades that drive results. Increase rents by making simple updates like fresh paint, better lighting, or improved landscaping. You'd be amazed at how small the improvements have to be. Attract new tenants by improving the curb appeal of the building, or maybe you're just marketing it better than the last group was, or maybe you're offering more competitive leasing terms. You can also cut the operating costs by streamlining property management, renegotiating service contracts, and just improving your energy efficiency. Small, thoughtful changes can have a major impact on a property's cash flow and its overall value. Step 3 is when you unlock the value and you actually scale up. Once you've increased the property's value, you have multiple options. You could refinance and pull out equity and reinvest in your next deal. If you've done residential, it's the BRRRR method. It's the exact same thing in commercial. You could sell at a higher price and cash out, or you could just hold and enjoy the stronger cash flow from higher rental income over time. The beauty of this strategy is that it allows you to actively create the value rather than just waiting for the market to catch up to what you're doing. Instead of relying on appreciation alone, you're actually controlling the outcome. It's one of the most beautiful things about commercial real estate, which is exactly why this is one of the best ways for new investors to start building wealth in the commercial world. This is the same strategy that I used on my first commercial real estate investment. I found a 6,000 square foot vacant building in a suburb of Nashville that had already been renovated, but the owner never leased it to any tenants. I raised $100,000 from 2 different investors, rolled in my $20,000 commission as the real estate agent, and bought the building for $575,000. After replacing one HVAC unit, we rented the building to 2 tenants and sold it in under 2 years for $750,000. Not a bad turnaround. Okay, so now we're going to actually underwrite a deal live. I'm gonna go through the entire process of finding a random value add project and putting it through the test to see if it would make sense as a value add deal. So to be as authentic as possible, Brent, what city other than Nashville should I take a look at?
Boston.
Boston?
Yep.
All right, Boston it is. That is definitely not a city I've ever looked at commercial real estate for.
All right, let's test your skills.
Let's test the skills out. All right, I'm gonna go ahead and look for Boston. We will limit this by retail simply because I know that it's going to be more of a triple net aspect. A lot of y'all are probably more interested in retail than necessarily anything else, maybe other than industrial based on my audience. But for today's purposes, we are doing retail. And I am going to limit myself here because I'm going for a value add project, right? And so if I'm looking at something online, I can't necessarily drive past it and just tell that it's a good deal. I know though that if I break it down in a price per square foot that is cheap enough compared to maybe everything else in the market or compared to what I think that I could build it back for, it's probably going to be a value add opportunity. So if I'm going to build retail today, probably $150, $175, maybe even over $200 per square foot. So I'm going to cap it at $80 a square foot, and let's see what happens. Price per square foot, max 80. I don't want to see any call for offers, no highest and best or an auction. I just want to see active listings on the market. And to make this a little more realistic, let's say it's less than 10,000 square feet. Okay, so here's a building that has been on the market for 284 days. That's a pretty good sign that this is probably got some hair on it. Time since last update, 75 days, which means the brokers probably aren't working too hard on it. $629,900. It looks like it's got a remaining term of 9.2 years on that lease. We're going to go ahead and scratch this right off our list because if the lease on that property is 9.2 years remaining, we're just not going to be able to come in and add any value until that lease is up. Okay, we're getting a little bit further outside of Boston, closer to Springfield. Let's see if this property is a potential. And the thing is, within this specific market, $80 a square foot may just be absolutely unachievable, and I might have to raise my price. Looks like this one is a mixed-use rehab opportunity, commercial and residential units with a parking lot. I'm going to pass on that because I don't want anything mixed use. So here's the thing. I mean, it's not always easy to find a value-add deal. If it was easy, everybody would be doing it. I'm just coming through here and checking off all of the single uses I don't want. I really just want to look at shopping centers because we want a multi-tenant opportunity for this. Come in here to all filters. We're going to raise our price per square foot up to $100 and max square footage 15,000 square feet. Let's just see what that pulls up. Okay, we found another deal in Springfield. Okay, this is probably a perfect property to do. We're looking at a retail warehouse showroom building, 12,476 square feet. It has been on the market for 315 days, and it is completely vacant. You can see here that the price per square foot is $71.74. If we were going to build this building back today, probably every bit, again, $150, $175 a foot. So I know coming in on the purchase price, and that's also not including the price of the land, by the way, that's just to build the building. I know coming in on the purchase price, I am half of what it would cost to rebuild this. So that's a pretty good sign that you've got a good value add opportunity. Let's see, it's 3 different parcels, one containing a designated parking area for roughly 10 to 12 vehicles. Always nice to have parking in retail if you can. Let's see, I-90 access, well suited for a local business that could take advantage of the daily foot and vehicle traffic. And it looks like there's a pretty large customer base nearby. Let's look at some more of these photos. Pretty much all they got. Just looking from the photos, it looks like the exterior of the building is either in very well, it's very well kept or it's in very good shape. The roof looks practically brand new. I'm surprised that they don't call that out in the listing. I certainly would if I had just spent, a decent amount of money on replacing the roof. I'd want to make sure that everybody knew that. Let's look at the flyer here. They could talk about it there. Okay, nothing really additional in the flyer. This is just one that is, self-generated by Crexy when using their platform. So that being said, I mean, I think I kind of have enough to, let's see if they have anything on the due diligence tab. Nope, they don't. So with that being said, I think that I have enough to actually put this deal into underwriting and see if we can make it work. So let's go ahead and pull up our underwriting spreadsheet. By the way, this is the spreadsheet that if you download my deal analysis toolkit, which I'll give you a link to at the end of this video, you can use this spreadsheet for underwriting all of your deals. It's not the most complicated one in the world. It doesn't take into account every single thing that you need, but it's going to get you 90% of the way there. So let's see, the square footage was 12,476 square feet. We'll just call this Boston. Come down here, purchase price. They were asking, why am I not seeing the purchase price anywhere? Purchase price of $895,000. I don't know what my capitalized rehab is going to be just yet because I don't know what I'm going to be doing with it. I'll figure that out here in a second. Closing costs, probably about right. Now that I've got the actual physical information of the building in, I'm going to go and look at the market and see what is going on with other retail spaces in the area. I want to know what things are leasing for out that way. There's a couple of different options for how to do this if you're utilizing a platform like Crexy. One is to just go and see what is actively available for lease. The other is to go in and look at the comps and records. We're going to start with the lease side first. So I'm going to come back to my search for properties tab over here. There we go. And I'm going to change my filters. Instead of for sale, I want to see retail for lease. This will give you all of the properties that are available in that area that are for lease. So you can start to look at what those costs are, figure out the rental rates. So it looks here like we've got $15 a square foot a year, $17 a square foot a year. So it looks to me like the two best comps I'm going to get out of this, and this one is retail single tenant, 9,300 square feet for $17 a square foot. That's a pretty good comp considering it's a close size to what we're considering buying. So let's look at this building a little bit more. Looks like it is formerly a dental office or some sort of doctor's office. Not too many pictures, but you can kind of get a feel for the inside, the exterior. Nothing special about this building. Again, very similar to the one that we're looking at, except the one we're looking at might actually be a little bit nicer. Although it is larger, the inside looks a little tired. Probably going to need some serious renovations. They are asking that, I wonder if it's on a triple net basis. It just says $17 a square foot per year. It is a triple net lease, right? So now we've got a comp. $17 per square foot triple net for a 9,300 square foot space, which is probably going to translate pretty well to our deal, considering it's only about 3,000 square feet more. Now, that doesn't mean that just because they're asking for it, that they are going to get it. So we're just going to bank that one for now. $17 a foot. Let's come back over here and look at this one that was $15 a square foot. Okay, this one is about 4,000 square feet. It looks like it is a pretty decent building. It's brick and no photos. You know what makes me really want to sign a lease somewhere is, oh, there we go. I was about to say, you know what really makes me want to sign a lease is a building that has no photos. Let's see. Cheap laminate vinyl plank flooring. You got some drop ceilings in there. I can't tell if those are LED lights or not. Pretty, I mean, looks pretty nice. I mean, if it's not new construction, then it's clear that they have touched everything up. The bathrooms look pretty nice. I can't stand that they did the same floor in the bathroom, but that's a personal preference. And yeah, looks pretty decent. Not too many windows in the spaces that they took pictures of. But $15 a square foot per year for 4,000 square feet, that's a pretty good comp. Let's see if they are asking for triple net as well on that one, and it is. So again, this isn't 100% bulletproof. If I was going to go through the process of actually underwriting this deal, I'd be talking to brokers in the market. I would want to know, what are you renting spaces for? What would something like this rent for if I was going to give you the listing? Give them the opportunity to pitch you on what that rental rate should be. But for the purposes of this discussion, we're going to assume our rents will probably be somewhere between $15 and $17 per square foot per year. Now, the other thing that I want to look at is how many spaces are actually available within this immediate market. And there's really not that many. I mean, I know when we zoom out this far out, we're seeing, 5 spaces over here in the Northeast, and we're seeing, a handful of spaces kind of southeast of the corridor that we're looking at. But when we were zoomed in to basically this specific area where I'm moving my mouse on, there's not a lot of spaces available there. So that to me says one of two things. Either there's so much demand that there's no space available, or there is so little demand that there's no point in listing space over there. Chances are good it's probably the first point that I made, but again, that's what you would do to verify the market. Go drive it. Go see, are there a lot of vacancy signs everywhere? Is it apparent that there are a lot of vacancies in the area? Okay, so now that I know what my price per square foot is going to be on the rental rates and that they are triple net, I am going to want to figure out how much work I think that I need to do to this building. The problem that we're going to have is that this property doesn't have any interior photos whatsoever. So I wouldn't be able to actually put together a remotely accurate construction budget unless I was able to get inside. It looks like there's a handful of windows on the exterior, really just a couple in the front, maybe a glass door, and there's no windows anywhere else. You can see back over here on the side, at some point they did have it set up to where there were windows there and they were filled in for whatever reason. I would want to know, were they filled in because it's in a dangerous area, or were they filled in because the tenant just had zero use for that and wanted to have more secure storage? That'd be one of the first questions I ask when I go and tour this space. So let's assume I toured the space, it looks great, and things are ready to move forward. I just want to have enough of a construction budget pulled together to be able to pay for an HVAC unit that goes out. Maybe a tenant wants to put a couple of walls up, or maybe they want to redo the flooring. I'm going to assume $20 per square foot on my tenant improvement budget, simply because I know from experience, $20 a square foot can go a long way, depending on what you need to do. And if nothing else, it's just money that's set aside that you don't necessarily have to draw down on, that you could spend to do whatever you need to with the property. So let's get back into our underwriting. We're going to assume $20 a square foot, which on 12,500 square feet is going to bring you roughly to, let's say, $240,000. So that brings our total to be financed to $1,135,000. So that's the total project cost right there. Now, operating capital, we'll get back to that. Pretty much the way that this spreadsheet works, by the way, if you are going to go download it, everything that's in blue you fill in, everything that's in white you don't touch. Let's assume we're going to put down a 25% down payment. 7.25% interest is probably pretty fair today. I've seen some interest rates as low as like 6 3/4, but we'll stay more conservative with our assumptions on this underwriting. I'm going to assume, just starting off, again to be conservative, that we're going to get $15 per square foot triple net. So here I'm going to put $15. And you can see it's automatically going to fill every box out there. So with 3% annual increases, which is what I have set over here, we're looking at about $187,000 gross potential rent in year one, going up to $192,000 in year two, and $198,000 in year three. Now, we have to account for vacancy loss, right? Because we're not just going to be able to step into this property and immediately have full vacancy. We're assuming that we don't have any downtime because there's no immediate construction that has to happen. So on my vacancy rate over here on the side, I'm going to assume that we fill up, let's do 3 tenants in this building, right? 4,000 square feet each, because that was one of our comps, was 4,000 square feet. I'm going to assume the first year we'll sign 1 tenant. So that brings us down to 67%. Let's just assume the second year we sign 1 more tenant, so we're down to 33. And then after that, we're fully occupied. We get down to a base level of 7% vacancy across the property because I'm going to make the market assumption that that's what market rate vacancy is. A bank is going to do that to you on your underwriting, despite if you're 100% occupied or not. Okay, under the pro forma operating expenses, we're going to be doing triple net leases. So technically, I don't have any of those expenses coming out of my pocket. However, I will have to cover those costs while we are still leasing the space. And then I always like to have a little bit of buffer in there just in case, right? So I'm going to say it's $3 a square foot for the first year. I'm actually going to have it drop down, and I am going to hard code in my spreadsheet to $2 the second year and $1 the third year. Because by the third year, we will have all 3 tenants in the space. And again, I'm being very conservative. Hopefully it doesn't take 3 years to find 3 tenants. But again, I want to be conservative in my underwriting to make sure that the numbers work. And we'll see if the deal flies or not. So by the third year, I'm still going to have some asset level expenses. There's still going to be some things that pop up that I'm just going to have to deal with as a landlord. And that's where I like to account for this in my spreadsheet. Okay, so coming down here to my net operating income, I can see my debt service coverage ratio, which is a very important number today. You want to be hitting at least 1.25 times debt service coverage. Looks like in my first year, I am only 0.30. Well, of course, I'm only signing 1 lease. It's going to take me a while. Year 2, I signed 1 more lease. Now I'm 2/3 full on the occupancy of my shopping center and have a 1.29 times debt service coverage ratio. That means we're making money in year 2 at 67% occupancy. That's a great sign that this is probably a good deal. We'll come down here. We're going to eliminate the asset management fee. Unless you're raising capital in a syndication, you really don't need to worry about that. As far as the capital reserves go, you're probably going to want that. I think 30 cents a square foot is plenty. We'll keep it at that. The number for capital reserves really depends on the investor, and it depends on how much of the improvements you're making on the front end versus what you expect to just pop up throughout the investment as you own it. Considering that this one is in relatively good shape, it's a light value add physically, right? Again, we said maybe paint and carpet, maybe an HVAC unit here or there. I'm just going to assume 30 cents a foot, so $3,700 a year just set aside. And on the capital reserves, I don't necessarily have a number that specifically makes sense or a formula that you could utilize on any given property that you're working on. It's kind of a gut feeling. What do you think is going to pop up? At the end of the day, some banks may require you to set a specific amount aside for your capital reserves, and other banks may just say, hey, if something comes up, you've got to pay for it out of pocket. As an investor, I like to have it in my underwriting, but that doesn't necessarily mean that I'm setting cash aside that I'm not touching. I just know, hey, at any point, I might have to spend $3,700 on something. Now, when I come down here to the profitability section of the underwriting sheet, I can see here under the investor ROI, I'm losing 15% on the first year. But that makes sense, right? I still have a mortgage, I still have debt service payments, I still have operating expenses for the property, and I'm only getting one tenant that year. But you can see here in year 2, it bumps up to 5% cash on cash return. And then look at that. Year 3, once the building is fully occupied, we're getting 23% cash on cash returns. Now, there's a lot of assumptions that I'm making since I'm not boots on the ground in Springfield, Massachusetts. Thank you, Brent. But 23%, not too bad. Again, you'll want to verify with a broker. You're going to want to dive into the market a little bit more. But to me right now, this is looking like a deal. I'm going to come over here. I'm going to change this. I don't think that we're going to get a 6.5% cap rate on the exit. Let's assume that it's just an 8%. Let's assume on the sale proceeds, we're going to have 6% in commissions and 1% in closing costs. So I'm walking away with 93%. This gives us a total return of 311%. That means that in a matter of 5 years, which is what this spreadsheet is based on, I am going to 3 times my investment. That's pretty good. If these numbers work out, this is a deal that I would absolutely do. Now, let's do a sensitivity analysis because I want to make sure if I'm not able to get the rents that I have, or maybe my expenses are a little bit higher, will the deal still work? So I'm going to come up here and I'm going to go back to my rent rate per square foot. Let's see what $12 a foot looks like. Right? I'm just going to change that so I can see how that affects my returns. Coming back down here, we're still getting a 144% profit, a 28% annualized total return. That means over a 5-year period, on average, you're making 28% on your cash and an IRR, internal rate of return, of 22%. Still very, very strong. Let's assume that my capitalized rehab is actually higher than I think it's going to be, and it's $350,000. Right, so we're adding $110,000 to the budget. I come down here and I look at my numbers. I end up losing money 2 years in a row. First year, 18%. Second year, I lose 3%. That's because my mortgage payments are higher because I'm drawing down on that entire construction budget, fixing up something in the building, and then I'm getting to go lease it. But you can see here, years 3, 4, and 5, we're actually cash flowing 9 to 10%. So not bad. Again, still a 97% profit. You're doubling your money over 5 years. You're getting a 19.59% annualized cash on cash return. Not a bad deal whatsoever. So that is how I would go about underwriting a value add opportunity. Now, there are some assumptions that I'm making, right? I understand the construction side. I've gone through a lot of the value add opportunities before, so I know what to budget and what assumptions to make when I'm doing that. If you don't, find a partner that's in construction. Find somebody that has built these spaces out before or that has gone through this process that can either mentor you, guide you through it, or be the contractor that can help you put a budget together. The next thing that you would want to do is to reach out to local brokers in the area, verify what the rental rates are, what they believe the operating expenses to be. They should have all of that information, and they should be able to confirm whether or not your assumptions are right. That's the biggest piece of this. At the end of the day, a lot of people get intimidated by underwriting, but it's just assumptions put into a spreadsheet. And you want those assumptions to be as accurate as possible, of course, but you can't control what the construction costs are going to be until you really get in there and start tearing out the walls. It's the same with our vacancy rates. You might sign 3 leases just by announcing that you bought the property, which totally changes what your pro forma looks like. So whenever you're actually doing your underwriting, do what I did here. Be very conservative. Beat it up. We went $3 per square foot lower than the lower price per square foot that we saw in the rents in that local market. We said it was going to take 3 years to find 3 tenants. We even said that it was going to cost us $110,000 more than what we thought it was going to cost to build out the space or just make any fixes that it needed. If this strategy makes sense to you and you're ready to start investing in commercial real estate, make sure to like this video, subscribe to the channel, and turn on the notifications. I post weekly videos just like this showing you how to get started in commercial real estate. If you want to take a deeper dive, check out my deal analysis toolkit, which has already been downloaded by over 1,200 investors. It's packed with the exact spreadsheets and checklists that I use to underwrite deals and make smarter investment decisions. You can grab it now in the link below. And don't forget to watch this video next on the basics of underwriting your first commercial real estate investment.